welcome everybody again for our weekly review. I think we had a great, I think last week we had a great investor day. Quite a few people attended. As usual, I think we had great discussions. So if you are, I think, part of that group, I hope it was enjoyable and we will definitely keep discussing more and more about the macro in near future. But I think we had a pretty interesting week. I think we have a few people here. We had good discussions right before we started recording. So let me just, as usual, I will start with the sharing and we can look through where the market is positioned. So let's first, I have started zooming in. I think we have done enough of 2025 reviews. So I will just go directly into what's happening in last few months. And this is the critical part. I would say that while it may not feel like that, SPX is almost sideways, right? And what if I tell you that if you just watch every Friday where the market is ending, it's like, it's basically within 3 points of last Friday and within 30 points of two week before and 3 weeks before. So basically every Friday we are seeing SPX coming back to exactly similar zone, 30 to 50 points, while where there's wild swings of almost 250 to 300 points. So what's really happening? I think basic idea here is that volatility has increased, as I think a lot of people have probably not observed that the biggest change which has happened in last few months is that like after the and every cycle it is happening, like it's mostly around earnings cycle, I would say. And this is where I think we have also discussed, right, in the investor day we were discussing this. We were currently discussing, what is happening in the last week or so. The volatility was very high, and this is a hallmark of where we are in the cycle. In this cycle where we had easy money, like we had a long time of low IV in 2025. And usually the volatility was attributed in those days to some kind of a tariff news or some kind of a macro with the Fed and so on. But what we are also realizing is that as the valuation keep going up, the VIX is every time there is an earning, and that's exactly where you will see that in the later part of January, where all the earnings came in from, especially from Mag 7. That's where I think the most anxiety and most of the pressure is in the market. Now, having said that, we did discuss that SPX is kind of sideways, but that is where I think what we need to understand is that Nasdaq, right? So tech is struggling since making a top in October. We tried to make a top in late January, but it did not sustain. So we didn't even make a new high, unlike SPX. And this is where I think most of the things are suffering. And I was just looking at the Mag 7 ETF or so, it's kind of, again, the same, right? We were talking about this October 29th or late October top. We are actually negative from there, even though SPX has made new highs since then. So this is, I think, the signature of the market. Like a lot of people who, I think everybody has been pretty heavily loaded, whether it's individual investor, whether us or anywhere else. All of us are tracking this Mag 7 trends and mega trends of AI. I think this is exactly what is happening. I think you may be feeling like why SPX is making new highs and why market is not giving you any returns, because the mega trends are taking a break. This happened, I would say, in late 2024 when there were questions around AI. It happened in early 2025 when we had this whole DeepSeek drama and so on. So market always finds a reason to pause, because always the valuation always run ahead of the short-term fundamentals, while the long-term story does not look like changing at this moment. Why I'm saying that? Because, and this is what I think, let's spend a few minutes on what happened after this recent earnings. So after the recent earnings, and because this was the first quarter and everybody was, trying to project where the 2026 year, the calendar year will look like. And as it happened, means it has left behind in terms of what is driving the economy. As we all know, it's mostly the capex spending on AI, and it is actually exploding even higher. Like the growth rates are even maintained at a very high rate in terms of billions of dollars. It's actually much bigger numbers now. We're talking about 600 billion plus. And as we have seen every quarter, it's only getting upgraded. It's not even question of whether they will do this much. Now people are wondering are they too scared to disclose to the market, and do they have even bigger plans? And this creates a totally different kind of a dynamics in the market. So what is happening is when people see, and there are still question marks on AI returns. So this is where the disconnect is. Some companies get beaten up. Some companies get excited. Some earnings result into 10% moves and so on. And I think that's what is really happening right now. So overall, this is where the market is. And now coming back to the last week, I would say this is the another ETF you can track very easily. This is the cloud computing ETF. This is talking about the the mid cap and small caps and the cloud companies and the software services company as we call them. Some people like I'm sure everybody has read this in the news recently, and it just totally collapsed in last few days. And the reason being, now not only people are worried about Mag 7, which is kind of flat or negative in recent days. Now people are worried about if AI is really disruptive, will it take away all the business from SaaS companies? And I think that's where means we did have some discussion in our WhatsApp group. So I will not going to go into that. It's again a very subjective thing. Where it started was again the a report from some of these Goldman Sachs and Morgan Stanleys of the world, where they started talking about these things. And I think that's where we are seeing this bigger concerns happening. So overall, again, as I said, right, means the market is mostly worried about. I would say they're rotating into smaller caps as a safety play. I would say it's more of a defensive play, and SPX is still making new highs. But overall, last 3 months are actually a correction, a much deeper correction in the market than what you would feel like by just looking at SPX, and that is visible from Nasdaq. That's visible from tech stocks, specifically Mag 7 and the SaaS players. Quick, before we start taking questions, let me just quickly go through a quick round of, I think there's nothing great to add here. I think we have talked about this, that the Bitcoin is actually kind of collapsed from its support. And this, as we were discussing right before the call recording started, we were talking about how this feels like 2022. This feels like where the sentiment goes worst and there is a heavy amount of liquidations. And we actually found support on those levels, long-term trend line. So if you go back to all the way from, the 2022 time, which we have been talking about, it's actually sitting, it actually bounced back from that trend line. So this is more like I would call it as a long-term trend, while we were always tracking short-term and this bull run, which was broken, I would say, earlier. But in general, this is something which we will only know in hindsight what's the real bottom. But overall, yeah, this looks like mostly the leverage, like we were talking about some of these hedge funds getting killed, and there are not a lot of news around very similar, which was happening in 2022 after the Luna and the FTX crash, if you were in the crypto space at that time. So very similar sentiment, and I think the bounce back also shows that some of these people are was just looking for this liquidations and grabbing this back in terms of buying. And it will be very interesting how it happens. And by the way, there are some other rumors that some overlapped hedge funds who were on silver that also triggered the final flush in crypto, while crypto were already weak. So these are the short term, like if you can see, like we did talk about, I think if you are with the Proflex, some of these macro calls we have been giving, we had highlighted, I think in last week of January, that we were seeing a lot of warnings, like a lot of visible concerns in the silver market. And this is what crash which happened in the late January. And I think right now we are just reeling from it. While again, look at this, like it doesn't break the short term, as we always, and we did spend a lot of time in our investor day, how we said that there are long-term trends and there are overlays of speculation. And we had reviewed that. So if you see, if you just ignore the spikes, and if you just zoom out, you will see that we are still in an uptrend. So the macro does not give you these spikes. These spikes are speculatory spikes. While the macro story will still be intact if silver or Bitcoin, they go back from these long-term trends. And even after, I would say there can be breakdown in these trends also. It's not like it's unlike that that it never happened. It does happen. The question is, then you just look at even longer term, because there have been cases when we had a longer bear market. So if you look at 1 week cycles, you will see that there was this another trend which was at a much smaller scale, and we never tested this. So you can come back to much longer term trend lines. Of course, we are not suggesting that that's expected to happen. I'm just giving you a perspective of how the longer term trend lines can still be justified using macro, because some people keep asking whether the story has broken. And I always say that story is like from a long term perspective, the macro still drives the story, but the layers of speculation is where you can never tell whether what is the top and bottom, and nobody can tell. It's all about now, how do you manage it? How do you manage is creating your risk profile in your advantage. Every time, let's say there's a drop, you means you have to decide. Some people use DCA, like we are using standard stock buying. A lot of people use dollar cost averaging. A lot of people use, just buy and hold is another strategy for riding long-term trends. And then like if you're using, like if you are with Proflex and we are doing options and so on, what we do is we keep readjusting. We keep readjusting the risk reward ratios and so on. And that's what we do for most of the cycles in stocks or Bitcoin or gold and so on. So as I said, so I think my goal was to give you a perspective that again, the earnings beyond the capex, I think, which we already talked about, is also showing the confidence. And if you see the earnings themselves have grown way higher than the estimates, almost all of them. So it's not that there was anything negative. It's more around the speculatory overlays, which are creating this kind of moves. And also, it's very visible in how they are managing the market by, as we say, that every Friday when the weekly expiry happens, you see that SPX settles down in very, very small, tight range, which also tells you that this is more of a institutional readjustments, volatility. They're trying to just liquidate retail and weak hands and flushing out the market and because of high leverage, which we have been highlighting since early January, the market was very, very kind of leveraged. So now I think that's a quick summary of the market where we think we are. And let me just stop share and like maybe give an opportunity for asking a few questions. Please go ahead.
Yeah, Raman. So I had a question on that capex slide that you're presenting, and we've talked about this earlier as well. So current, like 2026 and future capex spending, how is that leading to confidence in terms of revenue or free cash flow that will come in?
Mhm.
And
So I think.
a derivative question over there is, I'm assuming that our thesis is that we are investing in the Mag 7 slash big tech AI spenders, not just the data center providers.
Mhm. So, okay. So first of all, again, I'm not going to comment on any investment thesis here because this is more of a macro discussion. But let me just say, because there can be different things, right? So there are cycles of AI. AI is in a expansion mode, which is one of the biggest, I would say, transformative technology of last 5 years, or we can call it for this decade. So if you see where are we, right? Means in 2000s we had this whole internet story after the dot-com bust, of course, after the whole, and then we had 2010 to 2020 was a decade of cloud and SaaS and mobile smartphones, like you can call it Apple or iPhone growth because based on those kind of things. And now 2020 is turning out to be a AI decade, as we are calling it. So now in this decade, I think means you can always say where we are in this cycle. Nobody knows. Means of course the infrastructure is being built and we are not seeing it slow down. And I have repeated multiple times that why I means I know that there are a lot of always we have this discussion of bubble or crazy spending in 2024. We had in 2025 and 2026. Now again we are seeing the same narrative where market is being brought down. While my thesis is very simple that I would not trust the analysts. I would rather trust the capable leaders of these companies. Right? Means we are talking about companies which are multi-trillion-dollar. They must be seeing something. Of course, means we can always say, oh, maybe one day that they might turn out to be a Cisco or something of the internet time. And there are a lot of analysis of why that is not the case. But let me just take the bigger picture first, right? So now we are saying that these people are increasing spending. The AI is probably, and we are seeing the use cases in last few weeks also when we have seen Anthropic coming out with all this. Absolutely crazy models where they are able to go and build the products and run AI, agentic AI, and so on. But coming back to your question on free cash flow, I think this was a big shift, and this is what created winners and losers late last year, was when people realized that first people were getting comfortable that the companies which have free cash flow they are spending, and because these companies had free cash flow, they were spending and increasing the spend. Then the second wave came where late in 2025, people realized that they have to raise debt, and which, by the way, that had any industry before this, because there used to be no multi-billion free cash flow 5 years ago or even 10 years ago, right? This whole thing started only in very, very recent times. There was no, even the top companies or the top like Apples of the world and Intel or whatever, any generation, top market cap company of S&P 500 never has the size of free cash flow which modern day Googles and Meta and Amazon have. So that is where I think people got comfortable that, oh, this is all right, that they're spending from free cash flow. But in general, any new technology, like first wave of cloud was purely funded by debt. It's not like they had the free cash flow, but they were able to monetize it over time. And that's now they're going back to the same playbook, because what we are realizing is that this AI spending and the infrastructure spending which is needed for this AI, this is being estimated even higher and higher every year, and they are actually spending it. So they are seeing the opportunity. So now we are going to the debt-based funding. And remember that these companies are already multi-trillion. They can also raise equity. They can use preferred share. There are a lot of different financial tools which they can use to raise money. What I'm trying to highlight is, yes, at one point, people will start saying whether it is justified. And that is going to be, nobody will know, as we said, that just like the market, you cannot tell the top or the bottom. When do these companies end up overspending? This will only be known in hindsight. At this moment, at least from an industry perspective, they're seeing the justification, they're seeing the changes which is happening. On one hand, so look at the disconnect. This is where I struggle with the market. Like what you're saying is, on one hand, all the SaaS companies are going down with this thesis that AI, the new AI, it can totally kill all the software products because AI is so powerful. On the second hand, people are saying, oh, why are you spending so much? So this is where I think right now the market is confused. On one hand, they are getting kind of worried about the spending. On the other hand, they are saying AI is so transformational that most of these current software companies will die. So at this moment, I think when the market is confused, this is where market makers and speculators come in and they try to take advantage of that. So, and plus, as I showed you, the volatility is rising. And one more thing which we did not discuss probably is that now not only we have weekly option, now they have a, just like SPX, we used to have zero DTE, which is the daily options. Now even Mag 7, like, all the Mag 7 have a 3 times expiries. That increases the speculation. Means I don't know if it's a good thing or a bad thing, but definitely it's a bad thing if you are, an investor on a day-to-day basis, because if you're not able to use that hedging, or if you're not able to use the options, or it is very, very difficult because the volatility will increase now. We used to call it option day expiry on Friday. Now we have a Monday, Wednesday, and Friday only this Mag 7, and you have a 3 times a week. There will be expiries and people getting liquidated. So this is where I think we are seeing the impact in last 1 week, where the volatility was already high, and we had this extra options expiries coming in, which also had some impact on retail, which is almost gambling, right? Means most of the retail is kind of like they are looking to for reactions on earnings. When earnings are great, why is the stock falling? Because there is too much leverage. There's too much of bet on that particular move to happen. And you have to look at the data. You have to look, like when we are trading at looking at the institutional data, we are looking at, and we did discuss this in Investor Day meetup. There is a lot of background info you need to check. Where are the market positioned? Where is the positions taken by market makers? Where is the biggest liquidation levels? And that is the kind of asymmetry between what institutions know and what retail has knowledge, is where I think market is getting more and more volatile. And unless this retail participation, which has gone up like crazy in last 6 months, come down, this can be volatile. Like volatility can remain high. I would say this is where what we are seeing is the mismatch. But I don't know if I answered your question on free cash flow versus debt. But basically, right now, I think the market is going back to the old principles. So sorry for digression, but what you're saying is whether it is justified based on free cash flow. I would say no, because they are not thinking like that. They are thinking of it like, how did Google become Google or Amazon became Amazon? They never had free cash flow when they started, or the Facebook or anybody. They always funded it by either in the early days VC money, or later days debt, and that is how most of the new technologies are built in the world. Only last few years were the first time when people talked about using free cash flow for investment, because it was available, there was excess cash, and also they're optimizing that by cutting down their workforce, which is, we are seeing that earnings are continuously going up. I think this is probably the first time in last few years, since I would say the peak of COVID, what we are seeing is that software companies are able to continue increasing their per employee revenue and profits. We can call it, means either we can call it as cutting down the fat, or we can call it as maybe we are getting to a point where these companies are becoming more and more productive per employee. And we are seeing so many layoffs, and we are still seeing that this is not a normal thing in old days. So the world is changing. World is changing towards that you don't need that many employees. Probably the productivity is increasing to a level where they can continue to increase their network effect and their revenues with lesser workforce. So they're optimizing their free cash flow, and then they are investing in future for using debt and using other instruments, which has been the case forever.
Okay, thank you.
Yeah, and also I think the question again would be, means again, I myself feel worried about right now. Like, are we? Means every technology gets to a stage where people are over optimistic when you are building something. Um, but I would say that again, this is a matter of whether one company is doing it. Like I was always worried when OpenAI was raising so much money, but when Google validates it, when Amazon validates it, and when all these people are saying no, yes, we are we are looking at this market, this is transformational, and they of course see things before us, right? Means if Gemini 3 was launched, when people started really bringing the Google stock up and saying that wow, this is Google has really caught up. I'm sure they were seeing it internally, and the same way most of these companies, they have definitely better views internally in terms of where they are with this technology. And if they are voting with their dollars, where they're saying that we want to invest more aggressively, I would say that probably we should accept it, because we have seen already, not just in the software world, we are seeing how Tesla is progressing with FSD. We are seeing how robotics is progressing. So there's a lot of other things which are probably moving in this decade, and this is going to be probably one of the most transformational decade in terms of technology. And that is how the capex is not really um, abnormal, to be frank. I'm sure many people must have seen the recent comparisons of when the internet came, or even before that, railroads were built. And there are a lot of other examples which a lot of analysts have started putting together of whether we are in a really irrational investment cycle. Probably not. So I think that's that will be only answered in hindsight, as we always say, right? Means we will never know if AI really fails at delivering the productivity. Probably this will be all seen in hindsight as a waste of capex, and that will be very disastrous for the market. But for now, every month, I think market is excited about the new developments which are happening in AI world, and most importantly, they are not hurting the overall profitability. Like if you look at even the PE ratios, even if you look at the earning per share of these companies, it is still fairly healthy and probably going up. Like it's not like they have sacrificed their profitability while they are spending so much. Even by the way, we are still living in a pretty high interest cost world. Remember that we are also in a very much a macro cycle of where rates are expected to come down. They have already come down from last year. And maybe this was the whole idea, like last 2 years, that they already had a plan of capex. And because the rates were high and everybody was expecting them to be cut, they were using free cash flow and delaying the whole debt raise cycle, which is what is happening now. So market probably just had a different idea. Market thought that it will always be free cash flow based, so they have to adjust to the risks of debt-based expansion. All right, so I think let me take a few questions in the chat. Is it a wider usage of options also a culprit for the rise in leverage? I would say leverage, yes. The option volume were always rising. And as you know, like we are very heavily involved in this market. So I watch it every day, and I've been talking about it for like a few years. But I think there's always this whole retail euphoria cycle. And last 3-4 months, we have seen option volume even further rising in retail. So there's a difference between when retail is using more options versus institutional. And I think that definitely was a worrying sign, and probably that will create extra volatility. And that because the Robin Hoods of the world have already given this app in the hands of everybody. And one more thing we need to also understand, in whether it is the US market, or I think you have quoted the Indian market. Let me explain that one more trend which we always forget is that average investor of the today is like the money is getting transferred from last generation to next generation, and the new generation is much more comfortable with they were born in the Robinhood era, they were born in so as they are getting more and more money in their hands, you will see that this trend of people doing more options, people doing more short term trading and so on because the principles have changed in the modern age. Principles are not the same anymore like the previous. Like, so this is where I think we call, right, that in within US there is almost 30 trillion worth of wealth transfer from baby boomers to the latest generation. That's what is happening right now to millennials and so on, and the future generations. And probably we will. This is not a just a spike that more people are trading options, or it's retail is trading max 7 and so on. Also because in last 10 years the amount of information available, whether it is social media, whether it is all these access to too much analysis in the world, and now with AI everybody can ask any question. There is going to be even more and more information available. People will feel more empowered, and you will see usually humans tend to speculate more when they feel more empowered with information. So I'm not going to be surprised if this is, even though it is at a very high level, it keeps going up. This level of retail speculations and so on. So yes, I think, and unlike I think other regulated markets, US lets people play with it. I think as you compare with India, like they try to curb this. I don't. In fact, here you are seeing that exchanges are launching. If people are so excited about these options, they are saying, okay, let me give you 3 times a week. Why do you want to wait till Friday for expiry? And now they're giving max 7 option 3 times a week. The SPX has a daily expiry. All these ETFs, QQQ, and all these like the Nasdaq futures and so on. Everything is daily expiry. So you have so many tools. And this is how US operates, like US markets operate, that they give you ability to go and trade. So I'm not surprised with this, and I think this will continue. And this is where I think one has to learn that things will not be this things are not going to be easy if you are trying to read too much into day-to-day movement. If you are looking into, oh, the after earning the stock went down, that means earning was bad, or everybody should sell because market has decided that you should sell, then this is what will happen. What happened yesterday? A lot of people got liquidated yesterday thinking that, oh, this market is going down. And then you see something like today, which is where we see that institutions have already liquidated everybody, and now they are building their position because they have the better visibility into their books of how leveraged people are. And unfortunately, yes, the size of option market is becoming way bigger than the spot market. And as a spot, they can see how much, like, there is always very fixed amount of buyers and sellers, and because of the leverage, you can probably liquidate them much faster, or you can shake out the weak hands much faster now because of all this. So this will be a trend. Unfortunately, if you're a retail investor, just be aware of it. This is why we recommend using options in our favor rather than speculating on them. So we have our advanced option group for community to discuss their own trades. In all access, we keep sharing the rationale of how we are doing it. And I think in managed accounts, we're already using actively managing these risks. So I would just say that it becomes very critical if you are trading day to day to understand the impact of options and probably how to use them in your favor rather than what is happening if you are just speculating. All right, so I think I see one more comment about gold and Bitcoin. So the comment here is that what is the story? Has gold usurped the story of de-dollarization? So I would say this is again, I have talked about this, and I always maintain that sometimes we read too much into the short-term data versus long-term. So yes, Bitcoin has gone into correction mode, and this is not the first time. I would say Bitcoin corrected from 69K to 15,000 in 2022, like from 2021 peak. There was this 7 to 9 months or 10 to 12 months period where we had a correction of 70% or so. This time, I think we are probably yesterday, if you look at the bottom, it was probably more than 50% correction, which is something which has happened before. And this is what we were looking at the chart when we were looking earlier in this call, that it depends on what time frame you look at. It is still in a very heavy uptrend, and it is still, if you look at the theory in a longer term, it's still working, the de-dollarization theory on Bitcoin. And same thing is working for gold, by the way. Gold had a 10-year period from, before this bull run, we had to wait 10 years for even achieving previous high, which, it was actually just sideways or just moving in a very small range. So this is what happens when we have very heavy institutional, and, this is what happened this time with Bitcoin, is that now we are entering an age where Bitcoin is becoming like gold. Earlier, it was just seen as a digital gold, but now it's actually operating very similar to gold, because now you have ETFs, you have options, you have all kind of institutional tools, which basically made gold what it is today, right? So I would call this still like same theory. In the long run, it still works, and but it's more about if you're trading on a day-to-day basis, yes, it does hurt, because if you are looking, because nobody, it's always a hindsight view. Like nobody can call out when the top happens, because when you're in a bull run, every 10-20% correction get bought into. And by the way, this is not very unique to Bitcoin, right? This is what I was discussing at the start of the call. What about Microsoft? Like, do you think Microsoft story is over? Can you say that Microsoft story is over just because it corrected 30-35%? If Bitcoin corrected 50%, we have seen some of this mega cap correcting very heavily in last 3 months. It's not even, the usual, like when SPX is making new highs, you have something like one of the biggest market cap player like Microsoft has corrected by 35 to 40%, which is huge. And then similarly, we are seeing, the kind of drops we are seeing in some of these other players like AMDs of the world and all that. So they are still in the AI boom. Like there is no change in the AI story. The capex is increasing. But what happens is that when sometimes market goes through this cycle of expansion too fast and there has to be a correction, and as you zoom out, you will see that the trends are still playing the same way. It's just that we probably went too far out, ahead of the trend from the macro perspective, and there were speculatory overlays which really created those spikes. And you just have to readjust your risks. If you give up at the wrong time, yes, you will give up probably at this place, and you will realize that you know what, that was just a 6 month of deep correction, and now it's back, and maybe it will make another new high within next 12 months. So this is where I think my view is that just zoom out, and you will see that most of the trends are still playing. In short term, yes, it has gold has become the speculator favorite because it broke out, and we have been calling for that it is going to be the case when gold happens. Because when you are suppressed with all the paper money, with all the instruments, so much of hedge positions which were used to this range bound 10-year trade of gold, the spike was crazy. Same thing happened in silver. Like the number of long term traders on gold and silver, there are so many of them which got liquidated, who used to play both sides, and their short positions totally got overwhelming. And that's why this spike happened, and that will keep happening whenever we break out. This is how usually the aggressive moves end in. And I think all of them are playing exactly same. I still believe that gold, silver, Bitcoin, long term, they are still pretty much similar. They are capturing part of the total money supply, which is the M2 money supply, as we call it. And the allocation is still increasing into Bitcoin, if you see. But it's just a time frame. Like last 6 months, it was this is what some people call it, busting of a bubble, short-term bubble. And then you need to clear out the leverage. You have to clear out everybody who's buying the dip. And then fundamentals take shape, and the sentiment goes totally reverse. That's when there are no sellers left. And now the price can go up very fast, just like price comes down very fast. And that's what you will see once things settle down, because people, you need time. So one more thing in technical world, we call it as one thing is price correction, second is a time correction. Why time correction is important is that when the price corrects too fast and the buyers come in, the sentiment is not impacted, because you don't have the PTSD of this staying in the bear market. What happens with time correction, which is what Bitcoin had since, I would say, October. Now we are only like 3 or 4 months into it. Beyond a point, anybody or everybody who is trading will start giving up. So more and more number of people give up. That's when you clear the way for the next big bull run. Because now you don't, people are, every big up move, you will be probably selling now. Oh, because you don't believe it, because we are recency bias. Most of the traders have a heavy recency bias. And that's what we call it as, this is why the cycles exist. This is why people track the longer term cycles, that usually Bitcoin goes up 3 years and comes down, crashing down for 1 year. Then again, it goes up 3 years. Same, I think gold has much longer cycle than we spent like quite a bit of time in our investor day looking at the historic gold cycles last weekend. And that my goal there was to tell people that, as you zoom out, you realize the stories work. But what doesn't work is sometimes you start interpreting and giving up at the wrong time, thinking that the story has failed. The story has not failed. It's just that market too many people speculated and took the market far away from the equilibrium, and people got overconfident, and that those layer of speculators have to be cleaned up before the macro story continues. And that has been the case with, even if you look at somebody like Nvidia or something like, um, any kind of stock you can pick up which has gone up too fast, you will see those cycles. You will see last year DeepSeek, we had gone below $100 on Nvidia. We had seen even like, right now we have seen Meta coming down 15% after last earning, and after this earning going up 10%. So all these things are like sometimes not necessarily like, that story has changed for any of these things. It's all about how leveraged the market is, and how the short-term price discovery gets probably mispriced, and that happens because there's too much paper money, there is too many instruments, whether it's options, whether it's margin, whether it is short sellers, hedge funds, and this is, I think, not easy to explain without showing you the data, and data changes every day, and this is what we do. And we also did one session on that in Investor Day, that there's a lot of data. We explained what kind of data institutions have access to. Of course, you can get access to it. It's not that it's proprietary. You can always buy the data, but usually retail does not have the time or energy to go look through that. And this is where the mismatch occurs in the price. I do see a few more comments in the chat. I think one comment is about the Trump accounts. Yes, I think there is definitely another thing which we have not talked in these calls is there's going to be a check, kind of a stimulus happening, which is this for the new babies. This new administration is paying a certain amount of dollars for their stock market investments, and we are seeing a lot of billionaires matching some of these. So this is piling up in general from a state to state level also. So overall, I think I don't think at this moment is big enough, but at some point, all this new money coming in, does impact the market, right? That does create the culture change. What they are trying to do is to also create a culture for people to start investing, especially the people who cannot afford to. As we all know, the top 5 or 10% people are the asset holders, and 90% people don't even have the luxury to invest. Usually, it's not about the check size, it's about giving them an account, and the expectation is that it will create interest from the parents to also put in some savings into that. So I think that can be definitely stimulative for the market, and that has been, right. I mean, that's how the stock market is always evolved, with bigger and bigger market cap, because there's always continuous inflow and asset allocation. But I think it will be interesting to see how that plays out. Means I don't think it's going to be immediately a big factor, but it will be overall tailwind in next 5 to 10 years as people see these new accounts opening. But other than that, yes, again, I will just summarize by saying that it's all about, we always link back to that assets go up because of the overall money supply and allocation. The question to ask is, I think the theme of the question which everybody was asking is one asset story over versus other? I would say I am seeing upside in almost everything, like, whether it's gold, silver, Bitcoin, stock market, in the S&P 500. You just have to zoom out and you will see that the trends are pretty much intact. It's a matter of, the speculation, which has to be killed out, which has to be cleansed in every cycle. That's what is happening right now. And I would say, coming back to the earning which we discussed today, at this moment, earnings were all great. I think almost everybody has beaten S&P 500. We did, again, I will go back to what we discussed in Investor Day. Let me just summarize in one line. The one thing which we discussed was the earnings are probably at one of the best times. Like if you look at the average earning growth of S&P 500 stock in last few years versus what you are expecting in 2026 is probably 2 or 3x of the average. So we are definitely not in recession. We are definitely not in anything other than expansion cycle. So, but why it does not feel like that is because market always try to prices in 12 to 18 months ahead of time. And probably last year we ran up too much, or probably we built up too much leverage towards the end of the year. And we are just in a correction phase. And we are not in a correction phase in last week or 2 weeks. We are in correction phase since October. If you look at it, we are just rotating. SPX does not look like falling because we have rotated into small cap. But other than that, the mega trend is intact, whether it is tech, whether it is all these precious metal and crypto. I would call this as our last 3 months have a heavy correction in all these trends. And it will be interesting. Like I think we are either pretty close to the end of correction, or maybe we will see soon this trends. I mean, of course, at some point they will reverse, but I don't see the signs. I would love to discuss if anybody's seeing any signs. And this is why I was talking about this AI trend or capex spending or the macro and the money supply. I think all of them are looking pretty much tailwinds in near future. All right. So having said that, I think we did have a one more theme which we discussed in Investor Day. Let me just summarize that. That while the market were one way up for everything last 2 3 years in tech, we might also see, because the valuation definitely are not as good as they used to be 2 years ago. When I say as good, means of course you might say that PE ratios of some of these companies have actually improved, but the fact is that the upside was too very heavy, right? Means when we look at the capex spending which is happening now, and second thing is, as we move to free, one of the earlier question in the call was, we are moving from free cash flow to debt based investment. So market is judging them, right? So market is judging the winners and losers now, because earlier it was a no-brainer that anybody who is spending their free cash flow, um, they will at least grab some market share in the new AI world. Now the question is, at what cost? If you are going to load up the equity people, so remember the one very basic concept: when a company is picking up too much debt, and if they do not generate right returns, equity is our last in line, because debt will get paid first. Debt is the senior investor on top of your stock. So the valuations of the equity from institutional investor, they will look for even better performance just because you're adding debt, irrespective of whether uh, you know your earnings are great or whatever. This is what, like, perfect example is Oracle. They are basically bringing down Oracle just for one reason. Oracle has not done anything wrong. Like, they are like, other than just picking up huge amount of debt. And market is now saying, I need to price you down just because of the risks of the equity investor. If the same growth outlook, if you had taken less debt, I would have given you way higher, the P multiples and so on. But why should I carry the risks? That's what I think. Market will keep looking and keep redefining. And this is where I think I want you to always evaluate when a company announces a big funding round through the debt, whatever these Max 7s are doing. This is why you see this 10% drops or some big drops in this stock market every time they announce something big, right? This is what happened with Amazon when they talked about increasing their capex. So all these things do not mean that the earnings were bad or there's anything major wrong with the company. It's about the investors asking whether should, as an equity player, my value went down, because now I have to, the residual value of the corporate is after paying the debt for the equity. So that's where I think that's another fundamental factor which a lot of people keep asking me, that if the AI is expected to give the returns, why market reacts so negatively to these new debt structures, which was not the case for free cash flow, because that is where equity, it's similar spending increase, but because it is coming from free cash flow or from the revenues, equity people do not react that negatively, because they are not losing out on the corporate value. But as soon as you start adding huge amount of debt, that changes. So I think that's another reason which market is adjusting to and realizing how the Max 7 is behaving going forward. So this is one thing which you have to keep in mind. There will be a lot of back of the envelope calculations which investors will do, the institutional investors will do, and they might declare winners and loser, which will not be easy to understand from the first look at it. So there are a lot of theories on going around on top of that, on as this new funding rounds continue on the AI spending. All right. So any other questions? Like, we can take one quick question. I think we are almost at the top of the hour, but uh, great discussion. As I said, I think we are. So we will be making this recording available anyway. We did, as we discussed the markets where they are. I would just highlight one fact that as we are seeing that the volatility is high, I would just recommend everybody to mostly focus on what is your story you're investing in. And sometimes you'll have to take the pain. You'll have to take the pain for some time for the story to play out, because all the leverage, all the overlays of speculators are going to try to liquidate you. Or when I say liquidate, even if you're not using the margin, sometimes you just don't feel like, you exit at 10% loss. just because you felt like maybe I don't understand what's happening. So just be patient, I would say, because ultimately long-term trends play out. And that is what you need to have confidence in if you are picking and choosing the stocks, if you are doing your own research. But don't just worry about the price. Of course, you should always ask yourself whether your theory is intact or not, because that can also go wrong. But overall, I would say that this is not going to be easy market, and this is the theme of this year, where you will see more and more of these kind of leverage speculators on the top, because in general, this, as we discussed, the options market and the margin is increasing, retail participation is increasing, and that can be difficult to navigate because the volatility will keep going high, especially around earnings. We have been seeing that happening all the time. And do not try to play short term. Have a plan. Even if you're playing short term, play it with the right risk reward. Always ask yourself what is your maximum loss versus what is your maximum win, and you will be able to answer yourself what's the right place to be. All right. So I don't see any other chat questions. Let me give it another 10 seconds for anybody to raise hand and ask any question. You can unmute yourself. Otherwise, we'll close the call for the week. All right. So have a great weekend, everybody. I think I did see, okay, one comment, last comment. AI trade is benefiting another segment of players, foundries and memory makers. Yeah, I think that's a fair comment. It's very interesting, though, that yes, these people are benefiting, but there were also most of these players also go through a seasonal ups and downs because they are not capturing the maximum value in the semiconductor, as we saw, right? I mean, these are Nvidia's, AMD's, and Yavago of the world who take the maximum, I would say margin. They usually go up, and they are easy trades. But the problem which happened with memory and the previous of some of these downstream players was that even though they were benefiting, but the multiples were not there originally because there was this whole uh, seasonal cycle, right? There was the memory pricing is a commodity. What happened in last few months is not necessarily AI only. It's also because of the demand supply mismatch because AI created. And for short term, even the regular memories have been priced higher now because of the capacity increase takes time because the tooling takes time and so on. I would just warn people, if you're playing this is not just an AI trade. This is also more like a short-term speculative trade, and they usually correct very hard. So be careful, especially on the memory side, I would say. As soon as the supply comes online, suddenly you realize that they don't have the pricing power anymore because they're just a commodity, and the prices can come down very fast. And market tries to price in next 12 to 18 months. So even though you know that the earning is going to be great in next 6 or 8 months, 12 months, um, this stock can crash much faster because markets start pricing 12 months later. And if they are seeing any new fab coming in, any new supply, for example, if you're invested in Micron, SanDisk or something, and suddenly Samsung announces, or some SK Hynix or somewhere somebody announces totally new supply coming in within 12 to 18 months, um, market will probably start pricing that much earlier. That how it will impact the prices and so on. So just be careful when you're playing, while it is being called as an AI trade, because in short term that is the case. Also, you have to be careful that these are still commodities. They don't have the inherent pricing power which something like Nvidia's of the world and Avago and all these people have because of the IP involved. They can be very easily replaced, and there are a lot of competition in this market. So right now, definitely they are hot, and that is what is helping them. Just because, by the way, this was a trade play when somebody like Micron was at $70 or $80, even after the AI hype, everybody knew that they are the critical player into going into the AI data centers and so on. But it just turned around recently because people realized that yeah, the AI spending is continuing, and the memory is becoming critical part of the whole integration, whole the racks which they were talking about. Suddenly, the AI started start talking about the bigger models, and bigger, memory being the critical factor for running these bigger and bigger models. So I think that's was the surprise for the market. But I would say still, this is going to be very similar to Bitcoin and gold kind of story. When it has gone exponential already, and they become very risky plays because now everybody's speculating on these stocks just like they are on others. So just be careful when you're playing these. But yes, all of them are benefiting in this market. All right. So I think I will just take this for last one question here. Is it advisable to regularly harvest profit and pay taxes than getting hit by steep correction? I would say definitely this is if you have realized profits all through the year and you are expecting a big tax bill, definitely don't wait till April, because that is one thing. Means again, I'm not your tax advisor, but what I would say is that if you're planning your finances, remember that if you already know by end of December mostly what are your profits. So just start taking profits and plan it out. I don't think you need to plan the whole year. You can tax loss harvest. There are a lot of other things people do. But I would say don't wait till April. That's the only suggestion I have. Other than that, I think usually there is enough time from January to March to keep booking profits so that you don't have to do it in one go. I know that a lot of people face this trouble. And by the way, this is one more thing which is a headwind. As you hit, a lot of people don't plan, and sometimes people who have been sitting on profits, especially like employees who have RSUs and so on, they don't even realize that they are actually booking profits even without selling anything, because you actually end up selling for paying taxes, and those taxes held by the company are not big enough. They usually cut the minimum and you need to pay extra. So that usually creates a selling pressure on most of the Mag 7 and tech stocks in April, because that's when most of the people pay that. But I think market is already aware of this. This is very well analyzed, so you never know how it plays out. Sometimes people front run that and so on. But yes, I would say individually you should always try to figure that out if if you have taxes due. Again, thanks everybody. I think great discussions again. So we will keep trying to keep this at a macro level, trying to give a bigger picture view. That's my intent here, because market is very noisy, especially, but it means it can be very confusing with these big drawdowns and then big up moves. What happened today? So as I always say, zoom out a little bit if you are looking at the charts. Try to make sense from when you look at 1 year charts. Don't look at 1 hour chart. One look at 5 minute charts. That can really mess with your brain. So that's the only one suggestion I would say if you are a trader or if you're looking at market very closely. And have a great weekend. And we will come back next week and we will have this call. Thank you. Bye bye.